So right now, since you understand some basic terms, some basic title bonds we have, this is another basic information you need to know. But I think for 30-year student, you understand it already, right? Because there's I think it's mentioned from many finance courses, right? I guess so. Winnie, hi, long time no see, Winnie. Your major is finance, right? Then I think you know what does it mean. Could you tell me? Coupon, what does it mean? I guess you should see saw this term a lot, right? Coupon, what does it mean? You forgot? It's okay. Hannah, coupon, what does it mean? In finance term, coupon. Do you know? No? Jessica, do you know coupon? Sorry? Interest rate. What kind of interest rate? Coupon means the interest rate on the coupon. So what kind of interest rate printed on the paper? Contractual interest rate, okay? I guess in many finance courses have this word, right? So coupon, finance prefer use coupon this way, this term. So coupon means what? Coupon rate means what? Contractual interest rate. The interest rate on the coupon, okay? So contractual interest rate right here, maturity date, right? Price. What does it mean? 128.81. Based on this, how to get the selling price? Tiffany, price. What does it mean? If they didn't tell you the selling price directly, they tell you 128.81. What does it mean? That's not accounting, that's finance. What does it mean? Means the percentage of your principal face value. Okay? So it's your percentage of your principal face value. So here told you the price is 128.81% times your principal. Okay? Yield, what does it mean? Yield. Mark, yield. What does it mean? This is also quite common word in finance. Yield. Right? What does it mean? Rate of return, 报酬率, so means market interest rate. So what you could get from the market. So market interest rate. So yield means your market interest rate. Okay? So you should understand the terms in finance. Rating, what does it mean? BBB, BB plus is your credit rating. So let's go back to our slide where here BBB, BB plus. So which one is better? BBB, BB plus. So first company have a better credit rating. BBB. Oh, sorry, not BBB plus. BBB, BB plus. So did you find out? The first company is investment grade. Second company is non-investment grade. So which companies will have higher market interest rate? First one or second one? Higher interest rate means they have a higher risk. So higher risk have to pay higher interest rate to creditors. So second company should have higher market interest rate to creditors. So is it? Which one have a higher market interest rate? Second one. Why? Because higher risk have to pay higher market interest rate. Okay? Any questions? Okay, we've done all the basic terms for your bonds. Remind you again, it's like accounting definition is important. And this kind of finance terms also important because you don't know what does it mean. You don't know how to explain, the situations. Okay, so let's go back to accounting. Remember, when we issue the bond, we have three kind of situation. What's that? Issue at face value, right? Issue at discount. Issue at premium. 面额发行、折价发行、溢价发行。Then why? Issue at face value means what? Issue at discount means what? Issue at premium means what? Issue at face value means you could sell your bond with the price you expect to. So what kind of price you expect to? Principal, right? I expect pay the principal $100. Then how much money you expect to borrow today? 100. So when I issue at face value means what? Means you could sell the bond at principal. You could sell the bond as your expectation, right? My expectation is sell it at the principal. So I got the amount today, principal. Issue at a discount means you sell the bond with higher price or low price. Discount means sell the bond with low price, right? Because you give them discount. You got discount means the price is cheaper. So you can think in that way. Okay? And premium means what? Sell the bond with higher price, right? Okay? So why? Because your promise is not the same what investor want. That's why you have to sell it with higher price or low price. So could you tell me, issue the bond at a discount, you have to sell the bond with low price. Means, do they like your bond or not? They don't like your bond. That's why you have to sell it with low price. They don't like your bond means, do you satisfy investor? You don't. Means you promise to give them contractual interest rate is lower or higher than market interest rate. Lower, right? Your promise is lower than what they want, so they don't like it. Since they don't like it, you have to sell it with low price. Okay? Then issue at the premium means what? You could sell your bond with higher price. Higher price means, do they like your bond? They like it. Why they like it? Because they think your bond is good. Why your bond is good? Because you promise them more. You give them more, so they like it. Okay? So, which means contractual interest rate is higher than market interest rate. Okay? Did you find out? You don't need to memorize it. You just understand it. You will know whole situations. But have you heard about it? Not heard about it. Have you think about it? Why not? Market want 10%. Why not? We just promise 10%. Why? Market want 10%. Why I promise 8%? Why? For fun? We have more accounting work to do? It's not. Market want 10%. Why not contractual interest rate only 8%? We don't intend to do that, but we cannot. Why? Everything have a paperwork, right? So I decide want to give them 8% today. But when will you sell the bond? Today? Impossible. You need the time, paperwork. You need to apply to the government. You get government's permission, then you could sell the bond. So what's the problem? The problem is the time gap. So what's the time gap? You want to sell the bond on January 1st. You want to, so you made the promises. Okay, so when you made the promises, you think, okay, 8% is enough. Why? Because on the same day, today, market rate is 8%. Okay, so I want to. January 1st, market rate 8%. I say, okay, then I promise to give you what you want, 8%. So I made the promises, I print out the bond. You know, bond is contract. So after that, you have a paperwork, you have to apply to government. Said you want to sell the bond. But what's the problem? The problem is when you got the permission from the government is after 3 months. So after 3 months, like March 1st, you are allowed to sell the bond to the market. Okay, but what's the problem? Market situation have changed every day. So after 3 months, the market situation, what investor want after 3 months is 10%. So at this moment, March 1st, you want to sell the bond. The market said, I want 10%, but you just promised to give me 8%. So how could you sell the bond? At a discount, selling it with low price. Okay? So it's not because we intend to make contractual rate different from market rate. It's not. That's because of paperwork. Make your contractual interest rate is not the same as market rate when you are going to sell it. Okay? So on March 1st, when you want to sell your bond, how could you do that? Sell it at discount. Okay? So that's why your bond right now at March 1st, you could sell your bond 8%. So you could sell it at a discount. Okay? Any questions? So that's because of time gap, which make your bond issue at a discount or issue at a premium. Okay? But even though you don't understand that, you still can answer the question, right? Here just want you to understand the real world, how to operate the situation. So when we have a issue a discount or premium, it's not we intend to, it's because of the title, the paperwork. So they make contractual rate and the market rate when you sell the bond will not be the same always. So that's why the more common cases should be bond issue at discount or premium. It's quite rare we have bond at face value, okay? Because you want to make the contractual rate the same as market rate after 3 months. You know, there's a quite coincident. Okay? Then, so here, why? Here told you. Because of the time different. So there's a time gap. The time we made the promises, the time the bond go to the market, they will not be the same. Okay? But no matter what, remember I mentioned at the beginning, what is the true rate of return the investor get? Contractual interest rate or market interest rate? Market. When you want to do the business in the market, you have to meet, satisfy what they want in the market. Okay? So even though we cannot change contractual interest rate, why we cannot change contractual interest rate? Because it's printed on the bond, on the paper already. So could we change it? No, we cannot. Since we cannot change it, we could only issue at a discount, issue at a premium, trying to convince investors to buy your bonds. Okay? So that's why the actual earned by investors always should be market interest rate. So here I told you effective rate means 有效利率 means market interest rate. Okay? So different terms tell you the same thing is market interest rate.有效利率，市场利率。Okay? No problem? Then let's look at the cases. But here from your textbook, we have 4 cases. But I'm going to skip these 4 cases because they are totally the same as your first year. So since you've done the quiz already, so I believe you understand how to do this. Issue at a face value, issue at a discount or premium. Then for the following periods, we need to do what? Discount amortization, premium amortization, 折价、溢价、摊销 using which method? Effective interest method, 有效利率法 Okay? So totally the same as before. So based on this, we want to tell you the more complicated situation is for real world. Okay? So what's that? 2 additional issues. Actually, more complicated, but based on the same logic, more complicated. What's that? When interest payment date is not financial statement date. So what does it mean? Your company made the promises to creditors. So you promise creditors, I'm going to pay the interest on January 1st and July 1st, for example. So if you made the promises is what? You are going to pay the interest on July 1st and January 1st. Okay, so this is your interest payment date. But for companies, they are going to prepare financial statements. When they are going to prepare financial statements, well, it the same as interest payment date? No, not necessary. So what's the problem? The problem is if your company is going to prepare financial statement on, for example, December 31st, going to prepare financial statement in which day? March 1st. March 1st. June 30. Okay, prepare financial statement. So this is the first case. What's that? Interest payment day and prepare financial statement, they are not the same. So what should we do? Remember, for chapter 6, for this chapter, actually in accounting, it's quite important thing is what? Date. Date is very important. So you should understand the transaction happened on which date. But here, it's quite simple. You just look at how many months it have, then you just allocate the numbers based on the time, the months it have, right? So it's quite simple. Is you just look at how many months it have. So this is how many months? 6 months. And this is, actually it's not a good case because they're almost the same. So they should be the same. Here, how many months? Huh? Okay, it's not a good case. Sorry. Could I use this way? Okay. So, if interest payment date July 1st, January 1st, I'm going to prepare financial statement on February 28th, August 31st. So based on this, what should we do? How many months we have for each date? So that's it. So based on this, how many months we have? First should be 2 months, right? So there's 2 months. Second, from financial statement date to interest payment date should be 4 months. Then, from next one should be 2 months. Then, from your financial statement date to interest payment date should be 4 months. So that's it. How to deal with the first issue. Look at the times. Then give them, allocate the numbers based on the time they have. Okay? So it is difficult? No, it's not. You just need to be careful about the date. The date. Okay? So that's the first issue we are going to talk about. Interest payment date is not the same financial statement date. Second additional issue we want to talk about is interest payment date is not the same as issue date. I don't think we have a time to talk about this today, but no matter which one, the date, we use the same logic. So you just need to be careful about the date. So how many months you have, and based on the months you have, you just allocate the number into each period. Okay? So let's look at first issue. Right here. Actually, I asked the TA to let you practice the question on 14-9 before. Remember? But if you forgot, it's okay. So this is the question from your textbook 14-9. What's the problem? The problem is your company issue the bond. So the bond have the principal $100,000. So issue the bond. Oh, term bond. What does that mean? Term bond. We mentioned it, right? You pay the principal at the maturity date. So this is your principal. 8% is what? Your contractual interest rate. When you issue the bond? On January 1st, 2020. So this is your issue date. Due on January 1st, 2027. So this is your maturity date. With interest payable each July 1st and January 1st. So this is your interest payment date. An investor require effective interest rate. Effective interest rate 8% means what? This is your market interest rate. Okay? So you should understand all the conditions, all the numbers you need. So what's the problem? The problem is if we told you we are going to prepare financial statement when? Based on this, if we told you we are going to prepare financial statement on February 28 and August which date? 31st. So what's the problem? The problem is you will find out the date you prepare financial statement and the date you are going to pay the interest. They are not the same date. When they are not the same date, you should be careful, okay? Because they are not at the same date. Okay? Then what should we do? Before you deal with the problem, you just do the normal thing as before. Like what? Like prepare your discount, premium, amortization tables. Okay? So just get the tables first. Find out all the numbers. And based on the numbers to consider the time, the date. Okay? So what should we do first? For the bond, find out all the numbers we need as usual. So you should note what's N, what's I. N, how many years? From 2022 to 2027, 5 years, right? But you pay the interest twice, 1 year. So N should be 10, right? 5 years for 5 years and occur twice each year. So it's semi-annually. That's why N is 10. What's I? Market interest rate 6% for 1 year. So every 6 months, 3%. Okay? So what should we do? Find out what's your N, what's your I, always. What's your N, what's your I? Based on what's your N, what's your I, then you will get your present value of principal, your present value of your interest. Then add up these two numbers, you know your bond's present value is 108,530. So what does it mean? You issue at premium. Why is that? Because higher than your principal, right? So this number higher than your principal. Higher than principal. So issue at premium. So premium, how much? The difference between principal and your present value. You find out the the premium is this amount, $8,530. Okay? After you find out the numbers, the present value of your bond, so what's the next? Prepare your tables, right? So this is the table we have based on contractual interest rate 4%, market interest rate 3%, issue at premium. Okay? And the date, please, for your first column, the date, always, when we prepare this table, the date, we mean interest payment date. So based on interest payment date, we prepare this table. So did you find out when is your interest payment date? Every July 1st and January 1st. Every July 1st and January 1st. This is the date we pay interest. Okay? So based on each interest payment date, you find out the numbers. This is quite basic. So no matter what kind of issues you have, prepare this table first. And based on this table, we consider other situation. Okay? So what kind of situation we have? The situation is we are going to prepare financial statements. But your financial statements is on which date? February 28, August 1st, August 31st, right? So based on this, so what's the problem? The problem is The problem is, after issue day, we are going to prepare financial statement, or this is on your note, which page 5. You can look at your note on page 5. Okay? I'm going to prepare financial statement on February 28th. And I'm going to prepare my second financial statement on August 31st. But what's the problem? Because your financial statement date is not the same as interest payment date. So what should we do? Consider the time, okay? So from issue date to your first financial statement date, how many months? 2. From your financial statement date to your first interest payment date, July 1st, how many months you have? 4, okay? So just based on 2 months, 4 months, could you get the number for each period? Yes, right? Look at your table. First interest payment date, July 1st. What's the number we have for 6 months? The number we have for 6 months is what? $4,000 for interest paid. $744 for your premium amortization, right? So our first period, I know interest paid $4,000. I know premium amortization $744, but that's for 6 months, right? So we just allocate 2 months and 4 months. So how to get a number? 2 months. So how much? Right? Interest paid $4,000. Oh. Interest payment date $4,000 from your first period. Premium amortization $744 from your first period, right? So how to find out the number for 2 months? You just based on the date, the time. So it is $4,000 times for 2 months, then $4,000 for 4 months, then you're $744 for 2 months. You're $744 for 4 months. That's it. So it's quite simple, quite easy, right? How about your second financial statement date? Then you look at your second period. You will find out interest payment still $4,000, but your premium amortization is $766, right? If you look at your second period right here. So did you find out your second period? $4,000 the same, but your second period's premium amortization is $766, right? So based on this, still we classify them into 2 periods. So that's why here interest paid $4,000, premium amortization $766. Then you have to consider about the time. So $4,000 for 2 months. $4,000 for 4 months. and your premium amortization 766 for 2 months. 766 for 4 months. That's it. So it's not that difficult. You just need to be careful about the date. Then based on the date, consider how many months you have for each period. Okay? If you don't have any problem, please finish. Look at your note on page 6 and 7. So please finish page 6 and 7. Let me check, then you can go home.